Welcome to Money Matters. I'm David Crowell, and I'm the Senior Regional Mortgage Lender for Mortgage Network. Today, instead of talking about global events and national events and grand topics about the economy, I'm going to focus on mortgages, what the interest rate markets are doing, and what the impact looks like being here in the low country. So it's going to be a much more narrow focus today on the most immediate topic at hand, which is the low country, interest rates, and mortgages. Okay, here we go. The 10-year Treasury bill finished yesterday at 2.86%. That is lower than it has been over the last 2 or 3 months, and it's been bubbling along in quite a stable fashion for the last several weeks. 2.86% would indicate that interest rates are probably not going to be skyrocketing. We're in a very interesting period where the short-term interest rates, which are largely dictated by the Federal Reserve and its Fed funds rate, are at 2%. Long-term rates, as shown by the 10-year Treasury, are at 2.86%. So the spread between short-term and long-term would appear, based on the two government-sponsored rates, would appear to be about 0.8%. 2% over on the Fed funds rate for very short-term money, and 2.86% at the 10-year Treasury level. Now, what's interesting here is that when you translate that through to the marketplace, to the money that all of you borrow, the 2% Fed funds rate feeds the short-term lending that local banks do in the form of equity lines of credit, which is the cheapest money at the bank. The equity lines of credit are going right now for prime. Prime is 3% higher than the prime rate of interest is 3% higher than the Fed funds rate normally. So prime rate of interest is at 5%. Remember, Fed funds rate is at 2%. Add 3%, total 5% for prime. And then mortgage bankers like ourselves are lending 30-year fixed rate money as of yesterday at approximately 4.7%. Interesting, 4.7% is roughly 3% higher than the 10-year Treasury, which is 2.86%. So I don't want to lose you all with a bunch of numbers, but think of it this way. Short-term money hits the street, hits you at about 3% more than the very best government rate, and long-term money in the form of 30-year fixed-rate mortgages from Mortgage Network and from people like me hits you also about 3% higher than the very, very best borrowers can borrow at the 10-year Treasury rate. The best borrower in the country with the very best credit is the U.S. government, and the U.S. government is paying 2.86% for its money right now. So, and you're paying approximately 4.75%, which is only 2% higher. So you should be paying, in a perfectly efficient and orderly economy, should be paying about 5.75% for 30-year mortgage money. What has happened, however, because that would be 3% above the 10-year Treasury rate, However, what's happened is that there's been a compression in the yield curve between short-term rates and long-term rates, which has led to a flattening of the yield curve and very nearly an inversion in the yield curve. So, in fact, borrowers today are paying less for 30-year fixed-rate money by a long shot than would be predictable in a normal market. We have very little inflation. Inflation usually gets added into the equation, so it costs banks about 3% to lend. It costs them about 2% for the money, that's 5%. And then the rate of inflation gets added in on top of that. At the moment, rates are lower than they should be by classical models. So it's interesting. There's a surplus of money. There's a surplus of available investable funds, and that is holding back, because it keeps pouring into bond securities, it's holding back the interest rates. So with all of those numbers, what you can sort of distill out the back end of it is that 30-year fixed rate money is costing about 4.75%. It's right in there. That's about $5.20 per thousand of borrowed money. So if you borrow a mortgage today of $100,000, then your principal and interest payment will be $520. If you borrow $200,000, then your principal and interest payment will be $1,040. A $200,000 mortgage on a let's call it a $210,000 home, and let's make it a 97% mortgage, $206,000 home, $207,000 home. That $200,000 mortgage will be $1,040. The taxes on that property will be about $80. The insurance on that property will be about $80. The mortgage insurance on that property will be about $70. And when you add it all together, that's about $1,270. If you add a little bit for the homeowners association, maybe $50 a month, it's about $1,325 for a home in Bluffton that costs $207,000. The equation at these interest rates between rental property and purchased property continues to favor purchased property by quite a large margin. A new 3-bedroom, 2.5-bath house for $207,000 in Bluffton would rent for about $1,600 or $1,700. That same house costs $1,325 to buy. So you can see that the value proposition, that the marginal proposition very much still favors the purchase of a home over the rental of a similar property, if you could find one. What's causing that to be the case is a number of factors, only one of which is interest rates. And today's segment, my segment for Money Matters, is trying to keep focused on interest rates. So one of the things you need to, that I wanted to finish with, is to address the question that I'm frequently asked, which is, when, we know that interest rates have gone up over the last year from 3.75% to 4.75%. At what point, people ask me, at what point is that going to start to affect the market and cause the purchase market of real estate to slow down because real estate gets too expensive? The short answer is not yet. The value proposition is still strong. At 4.75%, we haven't seen even a blink in the market. Buyers are still absolutely stepping up to the plate, and rates have not impacted the market at this point. Okay, that's my segment for today. This is David Crowell from Mortgage Network, and finishing off this segment of Money Matters. Thank you very much.